Hi everybody, and welcome to the second in our series of special revision webinars covering aspects of financial economics. In the first session last week, available on YouTube, we looked at the causes of financial crises, including some contemporary examples. And in this session, we're going to think about some of the economic and the wider consequences or the effects of financial crises across different countries. So we're going from cause to effect. So what is a financial crisis? Well, we defined it last time as a major disturbance or a shock to financial markets, typically not always associated with a big fall in asset prices such as housing or equities, and also with an increase in insolvency, particularly amongst debtors and intermediaries, people who may have lent out money, which then has a kind of wider knock-on effect throughout the financial system and which disrupts the market's ability or capacity to efficiently allocate capital. In other words, things go badly wrong. And one of the things that came out of last week's session was that we've seen in recent times an increase in the frequency as well as the scale and severity of financial crises. There's been a number of crises both in developed, advanced countries, typically, of course, the US housing market, the subprime crisis of 10 years ago, which was the catalyst for the global financial crisis. We see it in the sovereign debt issue problems facing countries like Italy and Greece and Cyprus. We've seen it also in emerging markets. There's been several significant financial crises affecting countries such as Russia, Argentina, China in 2015, and more recently the currency crisis in Turkey. So financial markets are prone to crises. One of the things we came across last week was the idea of the Minsky financial instability hypothesis, which is a theory which suggests that capitalism and financial markets in particular are inherently unstable. So if you want to think about causation, check back to our YouTube video on causes of financial crises. I'm sure you'll find a useful source of information there. And of course, the pivotal moments, the moments we remember, we mentioned this last week, the collapse of Lehman's, which was allowed to go bust. They filed for Chapter 11 bankruptcy in September 2008. And panic ensued. It was the risk factor that the entire financial system would collapse was significant. In the end, we pulled through pretty much, but we didn't pull through unscathed. And that's what we're going to think about in this session. We're going to think about some of the consequences of financial market failure. So when we are evaluating the impact of a financial crisis, I think it's important to think of it in several ways, in several layers. What is the short-term as well as there's a medium-term impact of a crisis? Well, we think about it in terms of economic numbers and variables. So, for example, what's the consequence for investment by businesses? What's the consequence going forward for productivity of workers? And those two together form quite a substantial chunk of the underlying trend growth of a country. So does a financial crisis actually reduce the potential growth rate of a developed or an emerging market economy? Clearly, a financial crisis also has implications for jobs and for people's real living standards. There is a macroeconomic effect, which of course is the aggregation of microeconomic consequences. But I think it's also important, if you get a question on the impact of financial crisis, is to think about the wider, if you like, the human and the social context as well. So to what extent would a currency crisis or a banking crisis or a sovereign debt crisis impact over time on the levels of income and wealth inequality? Does it hamper the ability of a country to reduce levels of extreme poverty? What about the social tensions, the threat to social cohesion that comes from the fallout from crisis? And as we're seeing recently, of course, lots of elections in Europe at the moment, and wider afield, the financial market crisis of 2008, 2009 has had significant political effects which might actually take 10, 20 years to fully work through. In particular, the threats to democracy and the rise of so-called populist, often far-right nationalist parties. I think a third aspect is to think long-term, and that is to think about the extent to which a financial crisis is a catalyst for economic reforms of banking systems, regulatory change, There's also the long-term risk of hysteresis, that the jobs that you lose in a financial crisis could potentially lead to an increase in long-term unemployment. What about the consequences for debt? We'll talk about those in a few minutes. And also the extent to which a crisis is a factor nudging countries towards protectionism and away from free trade. I've put there a nice evaluative phrase at the top. The consequences, the effects of a financial crisis depend in part on the causes. And another key evaluation point is that the effects, the consequences, also depend on the effectiveness of policies designed to stabilise confidence and perhaps reform markets. So that will be my kind of framework for thinking about the effects of a crisis on one or more countries. Before we look at some particular examples, again, the sweep of history is quite important here. The chart on the left shows the annual growth rates of UK GDP since 1700 through to 2014. And what's interesting is that can you see the light blue there and the green? Those were the falls in GDP during the financial crisis in 2009 and in the 1930s in the Great Depression. So financial instability brings about what I would call tail-end events, significant falls in output that are much worse than we would normally see over the long time. And the chart on the right adds in United States, Japan and Germany, slightly shorter time frame since 1870. Again, the bits in green are from the 1930s depression, the bits in light blue, turquoise if you like, from the financial crisis. And again, most of those bad years, the tail end events if you like, were associated with, linked to financial crisis. Well, I suspect if you've been studying this, one of the key events, if you like, was the subprime crisis in the United States. Subprime loan is when you lend money to people to buy a property, a house, a condo, a flat, to people who are risky to lend to. They may have a poor credit history, for example, or they might be in a low-income job. But to compensate for the risk, typically the bank charges a higher rate of interest. And the subprime market in the United States, of course, eventually came a cropper in 2008 and into the rest of the decade. This chart shows mortgage delinquency rates for subprime loans from 2000. Now, a delinquent rate is a loan where 30 days or more has gone by without a repayment being made. And that, by the way, delinquency doesn't include the loan in the process of actually being called back by the bank, house being taken back as security. And you can see that from 2005, when about 10% of people with the subprime loans were behind, that figure shot up 2008 to nearly 20% and again to 25% when the American economy went into recession. That was the subprime crisis. And indeed, many of these homes were foreclosed. The bank basically called back the loan, or the homeowner left the keys in the door and left, leaving the house for the lender. And the foreclosure rate went up from a very low rate of 3% in 2005 to nearly 9% in 2007, and up to 15% a couple of years later. Nearly 1 in 6 subprime housing loans were foreclosed. Staggeringly high level, which continued through to 2012. Well, the subprime crisis was and is a financial crisis, but I think it's important to think about how the collapse of the housing market in the States had a much wider impact. And the phrase that economists use for this is the idea of externalities. So the US housing and mortgage bust, if you like, the fall in house prices and increase in foreclosures, that was the catalyst for a liquidity and a credit crunch. The banks effectively stopped lending to new borrowers and they cut back on lending to each other. So the financial system went into kind of lockdown. That credit crunch, that loss of liquidity and lending, then spread to other markets, including conventional loans, the insurance market, for example. And the credit crunch then was the cause of a pretty conventional economic recession in the United States. Real output started to fall, business confidence took a hit, and jobs were lost. The recession in the States, the world's biggest economy at the time, was also a key factor then behind a big fall in global trade and global investment. So the world economy was hit by this, and that prompted a recession in many advanced countries, including the UK. In the UK, from peak to trough, real GDP fell by 6% from 2009 through to the mid part of 2010. In Germany, output fell as well, but not as much as in the UK. It recovered much more quickly. Only a few countries managed to avoid a recession after the crisis. One was South Korea, another country was Australia, and another country was Poland. Might be worth checking out why those countries managed to avoid recession in the wake of the global financial shock. But the recession in most advanced countries was then a cause of effectively a banking crisis, because a wider banking crisis in financial markets. And of course, recession then led to a growing sovereign debt crisis, because governments were having to increase their borrowing, fiscal deficits were on the increase, they were bailing out banks, and the level of national or sovereign debt shot up in many countries. Now, that big rise in national debt, the externality there in the sense was there was increased pressure, particularly amongst fiscal conservatives, less so amongst Keynesians, of course, for governments to try to control the deficits above and beyond the automatic stabilisers. So it's significant pressure for fiscal austerity. In some cases, of course, that austerity was imposed upon a country. For example, Spain and Greece imposed by the IMF. And going forward, as we head into the sort of more recent times, that high level of debt and fiscal austerity have been two factors, amongst others, causing a long period of relatively slow growth in advanced countries, particularly those nations heavily burdened by debt. So where are we going with this? I hear you say, well, the housing market bust in the States can be seen as being a key cause of the period of slow growth that we've had since. This is the externalities of financial crisis. Here's a chart showing the loans given out by the Federal Reserve in the USA to banks worldwide from August 2007 through to spring of 2010. The Federal Reserve is the central bank system in the United States. And you can see here, for example, that the US investment bank Morgan Stanley received loans worth $77 billion over that period. And the Royal Bank of Scotland also was in the receipt of a big bailout. The UK government stepped in to almost completely nationalise the Royal Bank of Scotland because of its losses. So one of the consequences of the financial crisis was a huge rise in spending by governments to bail out banks, take on some of the debts, and by the central bank to support them. I think one of the key phrases I would use when you get a question on causation, on consequence of crisis, is the idea of contagion effects. So it's a bit like domino theory in a sense. One domino tips over and that can have very quickly a knock-on effect on many other sectors. So the subprime market in the United States goes into freefall. That affects mortgage companies. Mortgages are becoming harder to get and more expensive. Home builders build fewer new homes. Financial markets take a hit. That has a wide effect on the economy through to the global economy. The domino effect can be quite substantial. One of the major consequences of the crisis that hit the Eurozone, which in itself was caused in many ways by the financial crisis that preceded it, has been a big fall in investment. So you'll probably know that countries such as Greece and Ireland and Italy and Spain have been through major difficulties, including imposed fiscal austerity in Greece. Some of these countries are now beginning to emerge from the depth of a depression. But look at the chart here, which shows capital investment as a share of GDP for those 5 countries, the so-called PIGS. Ahead of the crisis, their capital investment ratio was rising towards 25% of their national output. That's now way down compared to what it was 10 years ago. So there's been a substantial slump in investment, which itself is the result of the slow growth and the difficulty accessing credit for fast-growing businesses. And low investment, of course, has consequences in the long term for productivity and competitiveness. One of the other consequences of the crisis, I think, is the fact that uncertainty has become much more prominent. You can actually check this out by the kind of frequency of articles in newspapers and things that mention policy uncertainty or economic uncertainty. And this chart is from the World Bank. Quite interesting stuff, actually. It shows clearly some spiky movements in 2008, big rise in uncertainty as the crisis hit, and things improved a little bit. Then another one, the sovereign debt crisis in Greece in 2012. Then it recovered a bit, and again in the last year or two, Brexit, Trump, Italian banking system under pressure, political uncertainty in Europe, a huge rise in uncertainty. Some people are saying that uncertainty in macroeconomics is the new normal. And that makes life hard for businesses and consumers when there's that degree of doubt about what's going to happen to lots of economies. The same chart is on the left-hand side here, but if you look on the right-hand side, I'd add this, that actually one of the consequences of the crisis has been not just a rise in uncertainty, but also a fall in trust, a fall in confidence of people considering their own national governments. So for most countries, there's been a significant fall in confidence in national government since 2007. Confidence in national governments is pretty low. It's okay in Indonesia, it's okay in India and Canada, but much less, as you can see there, in Greece and other countries, including Korea. So the sense has been, one of the consequences has been a loss of what's called political capital. People are less willing to trust elected politicians. Some crises have a direct effect on share prices. This is a really interesting table, and I would advise you, if you're listening to this on the YouTube version of the webinar, to press the pause button and have a good look at this. I'll spend a few seconds on it. This comes from the Judge Business School in Cambridge, and it's absolutely fantastic. It looks at what happened to share prices in previous financial crises, going all the way back to the South Sea bubble of 1720. Now, I wasn't around then, but the peak to trough loss in the stock market in the UK was 80% when the South Sea bubble exploded. And the Wall Street crash, 1929, share prices more than halved in the UK. They fell by 85% in the States. And in the most recent crisis, 2008, share prices fell by nearly a half in both the United States and the UK. Now, we know they've recovered since, in part because of the policy response, which has been very low interest rates. And it's quite interesting to look at the peak to trough loss in asset prices. I think another consequence of crisis, financial instability, is the impact on trade. Many of you will have studied international trade as part of your A-level economics, theories of comparative advantage and the gains from specialisation and trade and exchange in goods and services. This chart I think is quite instructive. The chart shows the percentage annual change in the volume, the quantity of goods traded across the world. And you can see the consequence of the recession in 2008-2009. There was a significant collapse in the volume of goods traded in the world economy. Now, the world economy is going into recession. I think world GDP fell by 2%, and by some estimates, world trade fell by about 15% over that period. Then you get the rebound effect, fine, and trade picks up because it fell sharply the year before, so that's the percentage rebound. But look what's happened since about 2011 through to the current period. Trade has been growing very slowly, well below the average from 1992 to 2008, which is shown in red. So we've had 5 or 6 years of below trend growth of trade in goods. And I think this is again one of the externalities of the financial crisis. There has been a shift, maybe a little bit away from globalization towards deglobalization. Some of the protective barriers have gone up, non-tariff barriers in particular, countries making more use of managed exchange rates and domestic subsidies, increased allegations of dumping of goods, for example, steel in overseas markets. So I think one of the externalities of the financial crisis has been a slowdown in the growth of trade, which you can argue in the long run is not good for living standards. Another consequence is for countries that are commodity exporters as well as importers. So here's a chart showing just an index of commodity prices in the world economy, energy in black, agricultural goods in red, and metals, hard metals in orange. And you can see again in 2009, the boom in commodity prices came to a staggering halt, big fall in the index of commodity prices. They recovered again in 2011 quite quickly, but since then actually the index has been falling. It's been the trend fall in world commodity prices, and that's bad news for many commodity exporting nations. But this chart is quite interesting from the point of view of thinking about the consequences for developing, emerging frontier economies. I just want to spend a second or two with you on this one. So it's really to show that the global financial crisis 2008, 2009 was essentially an advanced country crisis. The catalyst was, as we talked about, subprime, but the externalities spread out far and wide. So the rate of growth of emerging market developing countries, EMDE, obviously fell very sharply. In fact, they went into recession overall. They then picked up again. Subsequently, their growth has slowed down. Sub-Saharan Africa did experience a fall in growth in 2009, so they were not immune from the global financial crisis. Although their growth rate was still positive, it was above 3%, but you can see it did fall. Now, subsequently, of course, the growth rates of these countries have slowed down, which you could argue is a natural long-term process anyway. Or to what extent is that in part the result of the slow growth in debt-ridden advanced countries? So I've been trying to outline here some of the consequences of financial crisis. I just want to set up a few thoughts ahead of the next revision, which is about how you respond to crisis. When we go back to the September 2008, the collapse of Lehman, there were big, I think well-founded fears that the world economy was at risk of another depression, taking us back to the sort of 1930s. Remember that scene from The Big Short towards the end where everything seems to be getting pretty grim and Armageddon seems to be just outside the door? Well, of course, policymakers did not sit on their heels. This was a major external shock. This was a financial crisis, the likes of which we hadn't seen perhaps for certainly 60, 70 years. So in many countries, of course, there was a significant macroeconomic policy response. We saw deep cuts in policy interest rates. Bank of England cutting rates from 5.5% down to 0.5%. We saw the emergence of quantitative easing in many countries. Big increases in the base supply of money for the banking system. Many countries went for a fiscal stimulus, particularly in China, went for a huge fiscal stimulus, to a lesser extent in the United States. And of course, governments operating through themselves and through central banks' financial support typically bailed out some of the loss-making institutions, including in the UK businesses like Royal Bank of Scotland and Lloyds and one or two others as well. So there was a crisis of that scale, the shock to confidence, to profits, to credit, to jobs. The shock of that crisis needed a policy response, and it got it. This chart shows what happened to interest rates. The key thing here, of course, is what happened post-2008 in the United States. The Federal Reserve cut rates from 5.5% to pretty much zero. The Eurozone moved similarly, although later in the piece. They left it a little later. Japan had zero interest rates pretty much for 2 decades anyway, but gradually they cut to zero, and in fact they've now gone beyond that in terms of negative rates. What's interesting, I think, and this is really high level A-level stuff, so don't worry too much if this is beyond your syllabus, but I think what's interesting is that the financial crisis has brought about some significant deflationary pressures. One of the ways we see this is we look at what's called the equilibrium real interest rate. If you like, the kind of normal real interest rate in a country. Real interest rate is the nominal rate of interest minus inflation. So it's like the real return on savings or the real cost of a loan. Follow the blue line here. This is the real interest rate for the United States. It's linked to something called the Taylor rule. It's the rate of interest in real terms consistent with full employment, low inflation, and an economy growing at its potential growth rate, whatever it is, 2-3%. You can see that the real interest rate in the States is normally positive, but after the financial crisis, it fell quite sharply. So the equilibrium real interest rate in the United States is now estimated to be about 0.5, 0.6%. In other words, it's not 5%, it's not 4%. So in other words, we're moving towards maybe a new normal where the real interest rate is probably just positive, but not much more, in part because of deflationary fears. Have a look at the orange line. The real interest rate in the Eurozone has come down again from about 2% to negative, according to the World Bank. They think the real interest rate needed in the Eurozone to achieve full employment, price stability, and growth at potential rate is actually negative. The real interest rate has to be negative, about -1%. In Japan, of course, struggling to avoid deflation, the estimated real interest rate has been negative for many years. So I think one of the consequences of the financial crisis and the deflationary pressures that it has brought in is the need for a sustained period of low real interest rates. Indeed, we now, and this is hopefully contextual gold dust for you, we now live in a world where, as of January 2017, over a quarter of world GDP is produced in countries where interest rates are negative. The policy interest rate is negative. Obviously, the Eurozone is part of that. Bank of Japan is part of it as well. So quite a few countries now have negative policy rates, and we're also starting to see the rise of negative yields on 5-year, 10-year government bonds, which is a sign again of the kind of deflationary pressures in the world economy. Another consequence of financial crisis is that the banking system took a hit. Well, for some people that's good news, but this chart shows the rate of return on equity for the banking sector. And we make a distinction. The blue line is retail banks, your high street banks. The orange bit is investment banks, slightly higher risk. And the grey bit is banks that are both retail and investment banks. But what can you take from this? During the years before the boom, the rate of return on equity in the banking system was pretty high, 15% plus and higher for retail banks. They were making good money. Then they took a hit. They took a big hit, particularly in 2008. Especially banks which were both commercial banks and investment banks. Profits fell, negative return on equity. Do you notice what's happened since? So banks have taken big steps to try and cut the debts and to improve their balance sheets. But I think one of the consequences of the recession and the crisis has been that the banking sector has become less profitable. The commercial banking sector has become less profitable in particular. Now, what does that mean? Well, one of the consequences is that there's less money to be reinvested in customer service and branch networks, etc. Digitalization and automation, online banking is probably helping that anyway. But crucially, a banking sector that's not profitable is potentially less able to lend out to other businesses that need money. So I don't necessarily think the fall in profits is necessarily a good thing for economies. A couple of things to finish with. This is really setting up the policy response video that we'll look at next time. But there are essentially two approaches to the kind of big policy response to the global financial crisis. The Keynesian view is that what was needed and what we saw in many countries was a very strong monetary stimulus and a very strong fiscal stimulus. Because when the private sector is stopping spending, you need the public sector to step in and provide a kind of extra demand to stabilise confidence. So some countries did go for a kind of classic Keynesian fiscal stimulus, particularly labour-intensive investment projects such as new roads and bridges and new housing. Keynesians would also normally support the bailing out of some private sector businesses to prevent catastrophic job losses, which would cause a huge negative multiplier effect. The Keynesians would argue that in a financial crisis, when private sector confidence is shot, you must use monetary and particular fiscal policy to support animal spirits, to support confidence and prevent a depression, a semi-permanent recession following a collapse in demand. The Austrian school, on the other hand, and we'll look at the Keynesian Austrian school in more detail next time, but the Austrian school would be against bailing out. They say we should avoid bailing out loss-making banks because that leads to moral hazard. Banks will take even bigger risks in the future. You should avoid cutting interest rates to silly low levels because that means zombie businesses can survive, which in the wider scheme of things would disappear in a recession. And moral hazard and zombie companies ultimately hurts the long-term growth of a country. What you should do instead is you should fast forward your supply side reforms to increase competition in markets to try and lift productivity. And they're certainly against the idea of very, very low interest rates to offset a financial crisis. They believe it distorts the allocation of capital. So the Keynesian and the Austrian approach will be two different approaches to how you manage a financial crisis, given some of the consequences we've talked about in this session. And that's going to be a focus of our third special webinar on financial economics. Okay, you can follow me on Twitter if you'd like to. I tend to tweet most days with links and things to articles and supervision resources as they become available. I'm at Tutor to You, Jeff. All of our videos, including lots of the shorter exam-focused ones, are on our YouTube channel, so check that one out. But for the moment, thank you for joining in on this second special webinar on the consequences of financial crises. Talk to you soon.